You know that feeling when you try to understand the market, but it just feels like noise, numbers, charts, headlines, all moving too fast, all saying different things? You buy what looks promising, you sell when fear creeps in, and somehow you still end up wondering what you missed. It's not that you're careless, it's that no one ever taught you how to read the market, not just react to it. Hey book lovers, welcome to Bookzeal. This audiobook summary will help you see what most investors never notice: the quiet patterns, the hidden rhythm behind every market move. You'll learn how discipline, timing, and patience reveal the truth that emotions often hide. It's not about chasing luck. It's about learning the language of money itself. So, let's begin. Chapter 1. See like a winner. You can always tell when someone sees differently. They walk through the same world as everyone else, but notice patterns the rest of us scroll past. That's how winners see the market. They don't stare at tickers or headlines, waiting for a sign. They study the past quietly, obsessively, and they begin to recognize something simple but profound. The same patterns repeat over decades, across industries, through every bull run and crash. It's not luck, it's memory. The market has a language, and it keeps whispering the same truths to those patient enough to listen. William O'Neill spent years doing exactly that. He didn't approach stocks as a gambler or a guru. He approached them like a scientist of human behavior. He poured through thousands of charts, studying what the biggest winners looked like before anyone knew their names. What he found wasn't random. It was rhythm, predictable chaos, and underneath it all, one recurring pattern. When price and volume moved in harmony, greatness was often in the making. Most people, when they first start investing, think price charts are noise lines and bars without meaning. But once you learn to see, really see, those charts become a storybook. Every surge in volume is a chapter of conviction. Every dip is hesitation. Every sideways stretch is collective uncertainty. You start to read the crowd's emotions written in price. And once you do, selection and timing stop feeling like guesswork. They start feeling like conversation. It's strange though, because the first time you realize that success in markets isn't about predicting the future, but recognizing familiar footprints from the past, something shifts. You stop trying to outsmart the world. You start aligning with it. O'Neill called it pattern recognition, but really, it's self-recognition. The patterns you spot out there mirror the ones you struggle with inside: fear, greed, impatience, doubt. The chart doesn't just show what others are doing. It quietly shows what you would have done too. And the real work begins when you learn to see your own impulses in that data. There's a quiet kind of discipline in learning to see like a winner. You begin to understand that price and volume aren't abstract, they're human. Each spike and drop represents thousands of decisions, each made by someone reacting to hope or fear. Once you internalize that, you stop taking the market personally. You realize it isn't against you, it's just reflecting us. And yet, most people refuse to look. They chase narratives, opinions, and noise anything but the raw truth that history has already written. They want the next big idea, the quick tip, the sure thing. But O'Neill's research was never about sure things. It was about reliable clues. Because clues, when repeated often enough, start to form rules, and rules, when respected long enough, start to form wisdom. Seeing like a winner means building your vision around evidence, not emotion. It's about finding comfort in patterns that make you uncomfortable because they often tell you what you don't want to admit. Like the fact that when a stock breaks out to a new high, it's not too late, it's usually just beginning. Or that weakness rarely hides strength, no matter how cheap it looks. You start realizing the market rewards courage disguised as patience. The courage to study what works instead of what feels easy. The patience to wait for real confirmation instead of chasing intuition. There's a quiet irony here. The best investors don't actually think of themselves as investors. They think of themselves as students. Students of crowd behavior, of discipline, of timing. They know that mastering the market is impossible, but understanding it a little better each year is more than enough. Because when you see like a winner, you stop needing constant validation. You trust your preparation more than your prediction. You learn to hold curiosity longer than fear. And in that space between observation and action, clarity begins to form. The market keeps repeating its lessons. It always has. And most people will keep missing them because they're too busy reacting. But those who pause long enough to read what's already been written, those are the ones who quietly build fortunes. Not overnight, but over time. Seeing like a winner isn't about eyesight. It's about insight. It's about letting history teach you what headlines never will. That every great stock story begins with a pattern that's been telling the truth all along. Chapter 2. Earnings that change the story. Some numbers tell stories. Others change them entirely. Every great company has a moment, one quarter, one report, one turning point where the story shifts from potential to proof. That's what William O'Neill called the power of earnings. Not theories, not predictions, just undeniable results that rewrite how the market sees a business. You see, the stock market isn't a place where opinions matter. It's a place where evidence wins, and earnings are the purest form of evidence there is. They're not about noise or emotion. They're about truth, how much a company actually made, and how fast that number is growing. When that growth accelerates sharply, when profits leap 25%, 50%, even 100% higher than last year, something deeper is happening beneath the numbers. The business has found traction. And traction, in the market, is everything. That's why O'Neill taught investors to focus not on cheap prices, but on powerful results. Because a low price rarely means value, it usually means the story hasn't changed. The real breakthroughs, the ones that turn ordinary companies into legends, come from consistent, visible growth. The kind that's so strong it silences doubt. Think about it this way. When a company's earnings explode, it's not just making more money. It's signaling that its idea, its product, its timing, everything is resonating with the world. The market doesn't reward hope. It rewards proof. And accelerating earnings are proof that something is working brilliantly right now. But here's where most investors trip. They get seduced by what looks cheap, not by what's truly strong. They buy the laggards, the stocks that have fallen too far. They call it value. They call it patience. O'Neill called it denial. Because a falling stock is usually telling you something important. The business underneath isn't improving. And until it does, the price has no reason to either. Winners, on the other hand, don't whisper. They announce themselves. You see it in the reports. You see it in the charts. You see it in the way institutions quietly start accumulating shares weeks before the public even notices. There's a rhythm to it, a heartbeat of growth that's impossible to fake. And that's the shift O'Neill wanted investors to notice. That moment when the story of a company transforms from maybe to clearly, from potential to performance, from talk to traction. It's funny how uncomfortable that idea makes people. Because we've been trained to believe that buying what's already rising is risky, and buying what's fallen is smart. But in truth, the market doesn't reward what looks comfortable. It rewards what's real. The hard part is learning to trust the data when your instincts beg you to look the other way. To see those earnings stories clearly, you have to learn to ignore noise. Forget opinions, predictions, or narratives. Focus on the trend of results. A business growing steadily each year, year after year, is doing something exceptional. It's not luck, it's design. That consistency often points to management that knows how to execute, how to scale, and how to lead through cycles. That's what separates lasting winners from temporary excitement. The companies O'Neill studied, those with 3 to 5 years of rising annual earnings, weren't guessing. They were building momentum layer by layer. Each quarter wasn't just a report, it was a signal. And when those signals aligned with strong sales, innovation, and institutional support, they formed something close to inevitability. The irony is, once you understand this, investing becomes simpler, not easier, but clearer. You stop chasing rumors. You stop asking who's right. You start asking who's actually growing. Because in a world full of opinions, growth is the only argument that matters. And here's the quiet truth behind all of it. Great earnings don't just change the story of a company, they change your story as an investor. They teach you patience. They teach you to wait for real evidence, not emotional triggers. They remind you that wealth isn't built on guesses, it's built on signals that compound trust over time. When a company proves it's growing faster, smarter, stronger, don't argue with it. Don't wait for the crowd to confirm what the data already knows. That moment when results accelerate, when the story evolves, is the signal you've been waiting for. Because the real money in markets isn't made by predicting the next story. It's made by recognizing when the story has already changed and having the courage to listen. Chapter 3. Newness and Right, Time Entry. The market has a soft spot for what's new. New ideas, new products, new leadership, new breakthroughs that stir imagination and trigger action. William O'Neill noticed this long ago. The biggest winners, the ones that multiplied in value, always had something new fueling their rise. But new doesn't just mean different, it means better. It means the world suddenly wants what that company is offering, and it's willing to pay up for it. Whether it's a breakthrough drug, a revolutionary gadget, or a fresh shift in management, newness is energy. And in the stock market, energy becomes price movement. You can feel it when a company steps into that moment. There's a spark, a sense that something big is beginning. The numbers confirm it later, but the story starts quietly, in the way demand begins to build before anyone's talking about it. It's invisible at first, like the early stirrings of momentum before a storm. But once it becomes visible in the chart, once volume and price rise together, that's the market whispering, "Pay attention." Still, here's the paradox: most investors miss it. They're too busy waiting for comfort. They want proof, reassurance, safety. They wait until everyone agrees. The story looks promising, and by then, the opportunity has already passed. O'Neill understood that the right time to enter isn't when it feels safe. It's when strength is clear, and clarity almost never feels comfortable. That's what separates those who catch big waves from those who watch them from the shore. The great ones learn to trust structure over emotion. They study price and volume like a language because that's exactly what it is. Price shows enthusiasm. Volume shows conviction. And when both move together, that's not coincidence. That's demand taking shape in real time. But there's a trap too. Newness can also seduce. A flashy product or clever CEO can make you forget to look deeper. That's why O'Neill always combined new with proof earnings that accelerate, sales that climb, leadership that acts decisively. Real innovation shows up everywhere, not just in press releases. It's visible in execution, in follow-through, in the way numbers start to confirm the story. It's tempting to think timing is about luck, catching the right move at the right time. But O'Neill's research showed that timing is a skill born from patience and preparation. The patterns of great breakouts look the same over and over again. They build quietly, correct naturally, then surge as demand overtakes supply. And those who have trained their eyes to see it recognize the rhythm long before others do. The right entry isn't random, it's earned. It comes from watching a stock form, a proper base, from recognizing the quiet tightening before a move, from knowing the difference between a breakout driven by hype and one driven by true conviction. The key is to act when the setup completes, not after the crowd reacts. Because by then, the imbalance between demand and supply that drives the move has already done its work. And yet, timing isn't about being fearless, it's about being fluent. You don't need to predict the future, you just need to recognize when the present is shifting. A breakout isn't magic, it's confirmation that something new is gaining traction. That's the heartbeat of the market, the quiet pulse of progress. But here's the hardest part: you won't feel ready. You'll hesitate, second guess, replay all the what ifs. And that's exactly why most people never buy at the right time. Because the right time rarely feels right. It feels early, uncertain, a little reckless. And yet, those moments, those quiet edges of discomfort, are where opportunity lives. So you learn to enter not when the story sounds perfect, but when the strength is undeniable. You learn to buy when demand outweighs doubt. You learn to move not because it feels safe, but because the evidence is speaking clearly. O'Neill's lesson was simple but demanding. Success isn't about timing the market's emotions, it's about aligning with its conviction. Because when something truly new begins to work, you'll see it first in the numbers, then in the chart, then in the world around you. That's your signal. And if you can trust that signal more than your hesitation, you won't just catch the wave, you'll finally learn how to ride it. Chapter 4. The Mechanics of Winning Demand. Every market story, every chart, every breakout, every sudden surge comes down to one force: demand. The quiet, invisible current that lifts some companies higher while leaving others behind. William O'Neill understood that beneath all the noise, this is the one principle that never changes. When more people want something than there is available, price rises. It's the oldest truth in finance, and the simplest. Yet, it's the one most people forget. The stock market is just supply and demand in motion, millions of individual decisions forming one collective voice. But not all voices carry the same weight. That's why O'Neill paid close attention to the relationship between volume and price. When trading volume swells while price climbs, that's not retail chatter. That's institutions, mutual funds, pension managers, large players accumulating shares. They don't buy in whispers, they move in waves. And when those waves appear on the chart, they reveal something powerful: conviction. This is what separates great stocks from ordinary ones. A true leader doesn't need constant attention. It simply behaves differently. Its demand is heavier, more persistent, more structured. Laggards, on the other hand, might spike briefly, but their rallies fade just as quickly. They lack sponsorship. They lack belief. O'Neill urged investors to respect that difference, to always seek leaders, not laggards. Because the market rewards strength, not sympathy. It doesn't care which company you like. It only cares where money is flowing. And flow is everything. The best performing stocks don't just rise, they pull attention. They attract volume because their fundamentals justify faith. Their products resonate, their earnings grow, their management executes. And as the story builds, the balance between supply and demand tilts further and further in their favor. It's not random, it's the natural outcome of strength meeting recognition. Understanding this changes how you see every chart. You stop asking, "Is it too high?" and start asking, "Is demand still rising?" Because price alone means little without context. A stock can be at a new high for the right reason or the wrong one. But when that new high is supported by surging volume, that's a clue. It tells you institutions are stepping in. And institutions don't gamble, they commit. That's why O'Neill looked for quality sponsorship. Big funds don't chase rumors, they study results. When they buy into a company, it's often after rigorous analysis, and their involvement acts like quiet validation. You don't follow them blindly, but you listen. Because strong sponsorship tells you you're not alone. It confirms that your analysis aligns with the smartest money in the room. Still, there's a subtle discipline here. You can't just chase demand. You must learn to respect supply. Every stock has a limited number of shares available. When those shares are tightly held, when insiders and institutions own most of them, the available float is small. That scarcity magnifies each wave of buying. It's why some stocks move faster, why others lag behind despite good news. Scarcity isn't just an abstract metric. It's fuel. But this understanding also comes with a warning. When the balance reverses, when volume dries up, when price weakens without demand to support it, the same forces that created wealth can take it away. That's why O'Neill's method wasn't about hope, it was about observation. He taught investors to track the heartbeat of demand daily, to watch how volume behaves when a stock rises or falls, because those tiny details reveal when strength is genuine and when it's fading. There's something poetic about it, really. Beneath all the complexity of modern investing lies a truth as old as trade itself. Value increases when people want what's scarce. And in the market, that scarcity is belief. Belief backed by money, not words. Leaders thrive because they earn that belief. Laggards fade because they never do. When you start viewing each price bar as a measure of conviction and each volume spike as a footprint of confidence, you stop chasing stories and start following reality. Because the market doesn't hide its winners, it just tests how long you'll take to notice them. And when you finally learn to read the mechanics of demand, not emotionally, but truthfully, you stop fighting the tide. You start surfing it. And that's where every great run begins. Chapter 5. Align with the market's tide. The ocean doesn't care how strong you swim. It decides the flow. And your best move is to move with it, or resist and get pulled back. The larger financial environment works the same way. You can pick great projects, learn every principle, follow every rule, but if you move against the broader current, progress slows down. William O'Neill called this one of the most important truths in the world of growth. Align yourself with the direction of the tide. Many people forget that. They believe skill alone can outperform momentum. They keep putting in effort while the environment quietly weakens, thinking they found an opportunity others missed. But even strong ideas lose power when the overall current shifts. Because the direction of the tide isn't optional, it's nature itself. There are moments when everything feels smooth. Projects rise together. Results hold steady. Activity confirms strength. That's a rising tide, a healthy environment lifting everything along with it. Then come quieter seasons. When the energy fades, enthusiasm feels thin, and progress slows. You don't need to guess which one you're in. You just need to pay attention. The signs are always there in trends, in reactions, in participation. Those signals quietly tell you when to move forward and when to step aside. O'Neill taught that aligning with the tide isn't about guessing, it's about recognizing. You don't forecast the next wave. You observe the one already forming. The most consistent performers aren't fortune tellers. They're rhythm readers. They know when to pause during slow cycles and when to engage once strength returns. Because no idea, no matter how brilliant, can move freely against the weight of the entire environment. That's why he studied overall direction as carefully as any single detail. He looked at major patterns, not for headlines, but for signals. Rising activity with strong energy meant big players were getting involved. The tide was coming in. Declining movement with fading participation meant the tide was pulling away. It's simple, but often ignored, because it feels less exciting than constant action. Yet patience is the real power. The ones who endure, who stay consistent for decades, are those who know when to wait. They let the cycle reset. They protect their focus and resources. They understand that missing a brief burst of progress is far better than staying active during long stretches of decline. There's calm strength in that mindset. It takes maturity to admit that you don't control the current, you only control how you respond. And once you accept that, your whole approach changes. You stop forcing outcomes. You start flowing with reality. You can even feel the shift when it happens. In strong cycles, everything clicks. Actions align. Results appear faster. Confidence feels natural. In quiet cycles, movement slows and results feel delayed. That's your cue not to resist, but to adapt, to preserve what you've built and wait for the next wave. O'Neill wasn't teaching caution, he was teaching awareness. He wanted people to treat direction like a compass, not a forecast, but a guide. If the tide rises, ride it with discipline. If it turns, respect the pull and wait. Because pride costs more than patience ever will. Many struggle because they confuse persistence with progress. They think staying in motion proves strength. But real strength lies in flexibility, the ability to pause when the current shifts and to move again when it returns. That rhythm of advance and retreat, action and rest, is the true heartbeat of lasting success. It's almost poetic. The hardest part of progress isn't planning, it's acceptance. Accepting what the environment is showing you instead of what you hope it will show. That acceptance isn't weakness, it's clarity. Because life rewards those who move with harmony, not those who fight the flow. The tide always turns. It always will. And when it does, it quietly reveals who moved with awareness and who tried to stand still in a moving world. So when the environment feels strong, participate. When it slows, wait. When it steadies, return. Because every wise participant eventually learns the same quiet truth. You don't conquer the tide, you align with it. And that alignment, simple and calm, is where peace and progress finally meet. Chapter 6. Sell rules that save careers. Every investor loves to talk about buying the thrill of discovery, the excitement of catching a winner early. But the truth is, it's not buying that defines your future. It's selling. The decision to step away, to protect capital before the damage deepens, is what separates survivors from stories that end too soon. William O'Neill understood this better than most. He didn't just teach how to find great stocks, he taught how to keep what you've earned. There's a quiet discipline behind his sell rules. They aren't emotional, they're mathematical, almost surgical. The goal isn't to be right all the time, it's to stay alive long enough to be right eventually. That's why O'Neill insisted on one simple rule that has saved countless portfolios. Cut every loss quickly, at no more than 7% to 8% below your entry. No debate, no hesitation, no exceptions. It sounds mechanical, maybe even harsh, but think about it. Losing small isn't failure, it's freedom. It gives you room to stay objective, to see the next opportunity clearly. Letting a loss grow, hoping it will reverse, doesn't just destroy money, it destroys confidence. And when confidence goes, discipline follows. Then every decision becomes emotional, reactive, desperate. That's how careers unravel. Cutting losses early isn't about fear, it's about respect. Respect for the market's message, respect for probability, respect for the fact that being wrong is part of the game. Even the best investors in history, those who've built fortunes from scratch, lose regularly. What they don't do is let a small mistake become a catastrophe. But selling isn't only about losses. It's also about knowing when to step away from success. Because profits, if left unmanaged, have a strange way of vanishing. O'Neill believed in selling into strength, locking in gains when a stock has run far beyond its base, or when volume surges so sharply that exhaustion feels near. It's not greed to sell a winner, it's wisdom to preserve it. He compared the market to a mirror of human behavior driven by fear and greed. Fear makes us sell too early. Greed makes us sell too late. The challenge is to stand somewhere in between, to act from principle, not emotion. That's why sell rules exist. They remove the chaos of feeling from the logic of action. You can feel the difference between an investor who sells by plan and one who sells by panic. The first moves with calm authority, guided by structure. The second moves in waves of regret, reacting to headlines, clinging to hope, rationalizing every decline as temporary. But hope is not a strategy. Hope is what happens when you stop listening to reality. O'Neill also warned against the illusion of control. Sometimes, even perfect setups fail. The chart looks strong, earnings are great, and suddenly, the stock reverses. That's the market reminding you that no system guarantees success. The only guarantee you can control is the size of your loss. And that small act of control, the decision to exit early, preserves both capital and clarity. Selling well isn't glamorous. It doesn't make headlines. It doesn't earn applause. But it builds endurance, the kind of quiet strength that compounds over decades. Because every time you protect your portfolio from unnecessary pain, you protect your ability to keep playing. And that's everything. The irony is, the same investors who spend hours studying buy signals rarely spend minutes defining their exit. They prepare for entry, but not for impact. They love planning wins, but they avoid planning exits because exits feel like endings. But they're not. A well-timed sell is not the end of opportunity. It's the beginning of stability. You can almost feel the relief in doing it right. Selling a weak position cleanly, taking a small loss, and moving on with clarity. It's like clearing static from your mind. Suddenly, the noise fades. The future opens again. So here's the truth O'Neill taught quietly but relentlessly. Success doesn't come from how much you gain, but from how little you lose when you're wrong. Every great investor is, at heart, a great seller. Because the market doesn't reward pride, it rewards precision. And precision starts with the courage to close the door before the fire spreads. Learn that skill, and you won't just make money, you'll keep it. And keeping it, in the end, is what defines every lasting career. Chapter 7. Money Habits That Compound Wisdom. Making money in markets is one skill. Keeping it growing it steadily, quietly, is another entirely. That's where most people falter. They master the excitement of buying, even the discipline of selling, but they overlook the everyday habits that keep wealth alive. William O'Neill saw it clearly. Success isn't built on one lucky stock, it's built on structure. And that structure begins with how you manage risk, position size, and your own expectations. Risk isn't a headline, it's a habit. It hides inside the decisions you repeat unconsciously, taking positions that are too large, chasing trades that don't fit your plan, holding too many names just to feel diversified. That's why O'Neill taught investors to think in terms of percentages, not feelings. Never risk more than 1–2% of your total capital on a single trade. It sounds cautious, maybe even small, but it's what allows you to survive inevitable mistakes without emotional collapse. Because here's the truth most people avoid. You will be wrong, often. The market will humble you, sometimes violently. What matters isn't avoiding mistakes, it's sizing them so they don't erase you. The right position size turns fear into discipline. It keeps your losses tolerable and your confidence intact. Without that balance, every loss feels like a threat, and every win becomes an excuse for overconfidence. And then comes selectivity, the art of doing less, but doing it better. O'Neill believed that concentration, not chaos, creates clarity. It's tempting to own too many stocks, to feel protected by numbers, but spreading yourself thin doesn't reduce risk. It dilutes attention. True diversification isn't holding 20 random positions. It's holding a few exceptional ones that meet your criteria perfectly. He called it intelligent focus, knowing what fits your strategy and ignoring everything else. Because the more selective you become, the more consistent you get. Selectivity protects your energy, not just your money. It prevents what O'Neill described as diversification, the silent drift into mediocrity where portfolios grow bigger but performance weakens. Another silent danger is leverage the seductive belief that borrowing magnifies intelligence. It doesn't. It magnifies emotion. Leverage amplifies both gains and mistakes, turning small errors into devastating blows. The best investors use it sparingly, if at all, because they understand that peace of mind compounds faster than borrowed money. And that's the essence of good money management. Not speed, but sustainability. O'Neill's approach wasn't about maximizing returns every month. It was about staying solvent long enough for your edge to work. Wealth grows slowly when it's real. The market rewards those who stay consistent, who trade small when uncertain and scale up only when confidence is earned through proof, not through hope. Discipline, in the end, is a form of self-respect. It's how you treat your capital, your attention, your future. You don't protect them because you're afraid to lose. You protect them because you understand their worth. That's why he emphasized guardrails, simple, consistent rules that keep your process steady when emotion tempts you to overreact. Position limits, stop losses, risk caps. These aren't restrictions, they're freedoms, boundaries that allow you to stay objective in a world that constantly pulls you toward noise. But perhaps the hardest habit to master is patience. The patience to wait for setups that truly align with your criteria. The patience to hold through normal corrections when strength still exists. The patience to not chase trades just to feel active. Because activity feels like control, but often it's just anxiety disguised as productivity. Great investors move slower than they seem. They act quickly when evidence is clear, but they wait endlessly when it isn't. That balance between readiness and restraint is what compounds wisdom. Every trade, every mistake, every success becomes part of your education, and that education builds something deeper than wealth, awareness. In the long run, the difference between those who survive and those who disappear isn't intelligence. It's respect for the process, for the risk, for the market's rhythm. O'Neill's wisdom wasn't just about making money. It was about building habits that let you stay calm when everyone else panics, rational when everyone else speculates. Because once your habits protect your peace, you stop chasing quick results. You start compounding stability, clarity, and confidence, the three forms of wealth that never crash. And from there, money becomes what it was always meant to be. Not a game to win, but a mirror of how wisely you've learned to live. Chapter 8. Professional Playbooks and Lasting Principles. There's a quiet point in every investor's journey where the chase for shortcuts fades. The thrill of guessing, the constant rush to find the next big one, it all loses its pull. What remains is craft, process, a way of thinking that keeps you grounded when everything else turns chaotic. That's what William O'Neill left behind, not just strategies, but principles. The kind that endure through every market cycle because they're built on human behavior, not just numbers. Every professional knows this truth. The market rewards structure more than emotion. You don't wake up and wing it. You prepare. You study the winners, those stocks that rose hundreds of % and changed entire industries. You don't just admire their stories. You dissect their footprints. You ask, what did their earnings look like before the breakout? What did the chart whisper before the world shouted their name? That's how you build your playbook, by learning from what already worked. O'Neill's method was born from that discipline. He cataloged history's greatest stock winners and noticed they all shared the same DNA. Accelerating earnings, new products or ideas, institutional support, and the strength to lead their sectors. It wasn't magic, it was pattern. Once you've seen that pattern enough times, you start recognizing it in real time. You stop chasing noise and start trusting evidence. The professionals do something else too. They keep routines sacred. Before they trade, they review the broader market. They analyze indexes for volume, strength, new highs versus new lows, and leading sectors that are showing power. They know that staying aligned with the tide isn't optional, it's survival. They don't react to headlines. They respond to data. That's what separates process-driven investors from emotionally driven traders. And when news hits, because it always does, they don't panic. They interpret. They ask, does this change the fundamentals or just the mood? They understand that markets often overreact in the short term, but reality catches up over time. That's why O'Neill emphasized preparation over prediction. When your process is solid, you can absorb surprises without falling apart. Professionalism in the market doesn't mean perfection. It means consistency. It's waking up each day with a defined plan, reviewing what worked and what didn't, and refining the process like an athlete sharpening muscle memory. It's learning that your edge isn't speed, it's clarity. The more you repeat smart habits, the more they become instinct. That's also why professionals keep a short list of timeless rules close at hand. Rules written not in theory, but in scars. Never average down on a losing position. Always respect stop losses. Buy strength, not weakness. Add to winners only after they've proven themselves. Stay in tune with the market's direction. Protect capital first, chase gains second. Simple words, but they carry the weight of decades. O'Neill's greatest contribution wasn't just teaching people how to make money, it was teaching them how to think like professionals even when they're trading from their kitchen table. He wanted people to treat investing like a discipline, not a distraction, to see it as a craft worthy of patience, study, and humility. Because in the end, the market rewards humility. It punishes arrogance. Every time you think you've mastered it, it finds a way to remind you who's in control. Professionals don't fight that they flow with it. They accept uncertainty as part of the job and let discipline do the heavy lifting. And over time, that discipline becomes something more than financial. It becomes personal. The same traits that build great investors, patience, adaptability, emotional balance, also build a stronger, calmer life. Because the lessons are universal. Protect what matters, trust what works, and keep learning no matter how much you think you know. Maybe that's the quiet irony behind O'Neill's philosophy. The longer you study the market, the less it feels like a game about money, and the more it feels like a mirror reflecting your own growth. In the end, the principles stay the same. Study what wins, respect the tide, protect your capital, stay disciplined, keep learning. And as you do, something rare begins to happen. The noise fades, the anxiety settles, and your actions start to feel effortless, almost peaceful. That's when you know you've crossed from guessing to mastery. Because professionalism in investing isn't about acting smart, it's about staying steady. And in a world built on motion, steadiness is the ultimate edge. If this audiobook spoke to you, take a moment, share your thoughts, your lessons, your own story of discipline and discovery. Like this, leave a comment, and subscribe not out of habit, but as part of a shared journey toward thinking, investing, and living a little wiser every day.